Let me invite everyone who is here to be seated, and let me welcome everyone this morning, particularly our important witnesses that we have today. This morning, the Banking Committee is meeting to conduct an oversight hearing on the condition of the banking and the thrift industries. Before doing so, I would ask members to vote on favorably reporting the following nominations. Mr. Robert Larson to be a member of the Thrift Depositor Protection Board for a term of 3 years, and Alan Diamondstein to be a member of the Board of Directors of the National Corporation for Housing Partnerships for a term expiring October 27th of 1995. And if there is no objection, the period for voting will begin now and will extend through the duration of the hearing, and if we have a quorum of members arriving and casting votes during that time, the nominations will be reported to the full Senate later today. So without objection, we will be voting then through the morning on those nominations. With respect to the purpose of our hearing today, we have held now, over the 6 years of my chairmanship of this committee, a great number of hearings on the condition of the bank and thrift industries. We've done that each of those years, now a total of 16 hearings, and I consider them to be a vitally important part of our committee's oversight responsibility. Over the years, these hearings have been extremely valuable in both in terms of evaluating current developments in that area of the financial structure and to identify potential future problems. Today's panel, which includes all of the depository institution regulators, should enable us to again do just that, see where we are now and to take a look ahead as to issues and problems that may be on the horizon that we need to understand and we may need to deal with in one fashion or another. So we have with us this morning Mr. Chairman Alan Greenspan of the Federal Reserve, Gene Ludwig, Controller of the Currency, Andrew Hove, Acting Director of the FDIC, Jonathan Fichter, Acting Director of the OTS, and Norman DeMoores, Chairman of the National Credit Union Administration. And again, I want to welcome you all and say that we're pleased to have you with us this morning. And starting out today, certainly the news in this area of our economy is much better than what we have heard in the past. 6 years ago, we inherited at that time industries in their worst condition since the Great Depression. The S&L Insurance Fund was bankrupt beyond recovery. The cost of protecting depositors was enormous, roughly $150 billion, and most of that was paid for by taxpayers. For a while, it appeared that losses in the banking system stemming from bad loans made in the mid-1980s might approach that scale. But while the Federal Deposit Insurance Fund became briefly insolvent, the banking industry was able to cover the costs with only temporary Treasury assistance. Since insurance losses at banks amounted to more than $20 billion, and the weakened industry's need to retrench in order to rebuild balance sheets helped lead to a credit crunch, that clearly deepened our last economic recession and delayed our recovery. That is now behind us. Considerable progress has been made, as we will hear from the various regulators today. I think it's essential that we not only review carefully this period that we've been through, but draw from it the lessons that we need to make sure that we take every possible step to forestall a disaster of this kind from ever occurring again. Failures of laws and regulation were numerous, and this committee was forced to address those in a series of strong legislative measures, particularly the FIREA legislation of 1989 and FDICIA in 1991, which included, among many things, a set of enhanced regulatory authorities, a minimum but much stronger supervisory and examination standards, and a system of prompt corrective action. I think these things, together with other factors, have gone a long way toward helping the industry get on a more stable footing and to be in a position to remain there on into the future. We expect now, in terms of reviewing where we are today, to find that we have much better news to examine. Second quarter data that were released recently by the OTS for the thrifts in the country, and I understand that we're getting information that will be released this morning by the FDIC for banks as well. Together show profits at or near record levels and capital ratios among the highest in recent decades. So there's been a very strong balance sheet recovery and also a strong earnings recovery, and they obviously relate to one another. The Bank Insurance Fund, for its part, is now on the verge of complete recovery, and our credit unions continue to grow and are in a strong position. But as we know from experience, past problems have often developed during prosperous times. So I think the most important part of today's hearing will focus not just on the progress that's been made and the much more solid footing we now see, but to try as wisely as we can to look ahead to see where the regulators think the principal risks might lie in the future. We have a very dynamic system, and clearly we are in a full-blown global economy, and so this poses new questions and issues all the time, and I think it's essential that we tee those issues up, understand what they are, and be vigilant both within the regulatory apparatus and here in the Congress in our oversight capacity in understanding these things and attempting to foresee problems and to deal with them as appropriately as we can before they become engulfing problems. I think in that area, certain items deserve discussion today, which include derivatives, disparities in bank and thrift insurance premiums, and capital regulations for insurance rate risk, among other issues. And we'll be pleased to hear from our witnesses shortly. I know Senator D'Amato is intending to be here, and I think he's been delayed, and so I expect him shortly. I know Senator Murray has to leave shortly, and after I call on you, Senator Bond, I'll go to Senator Murray, and then, with the forbearance of Senator Shelby, and then we'll go right on down the table.
Well, thank you very much, Mr. Chairman, for holding this important hearing on the condition of the banking and thrift industries. I must apologize. I've been called to make another presentation at 10:30, so I'm going to have to review the written testimony as presented and also the record of the hearings. I do want to indicate that I wish to be recorded when the vote is held in favor of the nominations of Mr. Larson and Mr. Diamondstein. Clearly, as you pointed out, this panel has had some very interesting times looking at the financial institutions in the United States, and we have had some more than exciting periods when we have had to work with the regulators in attempting to fashion legislative as well as administrative reforms. It's always gratifying to hear Chairman Greenspan and the other experts come before us. I note in the morning paper where there's discussion of the interest rates. There's also discussion of what the OCC is doing in the Community Reinvestment Act. This hearing is not only the culmination of reviews of issues that have affected the related industries in this past year, but I see this as an opportunity for us to build a foundation for possible legislative action next year. And I, too, am interested in hearing the testimony on derivatives, regulatory burden, and the Community Reinvestment Act. As I understand, the OCC is moving towards more results-oriented regulation and community reinvestment to cut down on paperwork, see that the job gets done. I think that's a move in the right direction. Regulatory burdens, we've taken some small steps, but I believe if you listen to the people in the industry in my state and other states, you'll hear that there are a lot more opportunities where we can progress. With respect to derivatives, it's my belief that had derivatives been fully available and more appropriately utilized, particularly by the thrift industry in the late 70s, they could have lessened, if not eliminated, some of the interest rate risk due to the term mismatch on the interest rates in the savings and loan industry, and I think that's important to consider as we take a look at those particular products in the future. Mr. Chairman, I want to express my personal appreciation to you, to your commitment in both the banking and housing industries. In case this is the last hearing we have this year, and who knows, we might even get out sometime this fall. But before we do leave, I want to express my appreciation to you, how much I've enjoyed working with you. To the extent that we've been successful in this committee, it has been because of your energy, your vision, and your willingness to work on a bipartisan basis on many of the very difficult issues that have faced us. And I think that's one thing that all of us on both sides of the aisle can take some pride in. We've been successful with the passage of the Community Development Banking Act, the Interstate Banking Efficiency Act. We may even get lucky and pass another one before this is out. But it has truly been a pleasure to work with you, and I appreciate the spirit and the accommodation which you have shown to us. It has enabled us to accomplish much in some very difficult times. Thank you, Mr. Chairman.
Much. I appreciate your comments, and I appreciate the help you've given. Senator Murray.
Well, thank you, Mr. Chairman, and I associate myself with the comments made by Senator Bond, both in regards to the banking industry and his compliments of you as the chair. And I hope this is not our last hearing, but I have really enjoyed working with you as well. And I also welcome our distinguished panel of guests and witnesses today. I'm pleased that we are finally getting a chance to talk about how the economy is doing, how inflation has remained subdued, how successful we have been at lowering the budget deficit, and how well the banking industry is improving from the crisis of the 1980s. Experience on this committee tells me we probably won't stick to these subjects, but I hope that we try. Unfortunately, I cannot stay, as the chairman has pointed out. I'm on an appropriations subcommittee that is meeting today. But instead of making an opening statement, I would like to point out two concerns I have, and I hope that the panel will address them. I will be checking back to hear what the responses are, and with your permission, would like to submit the questions in writing, Mr. Chairman. The chairman of the Federal Reserve knows how much I respect and admire his judgment and really appreciate his service to this country. It's been invaluable. I really believe we are a richer nation because of your wisdom. But Dr. Greenspan, I hope that you will consider average Americans when you deliberate on the next rise in interest rates. We have car payments, mortgages, tuition loans, and these are serious concerns for many American families today. I know you have your eye on inflation, but I have to tell you, I get a lot of mail from friends at home, and every time I go into the grocery store, somebody stops and taps me on the shoulder and asks me not to raise interest rates. I assure them I don't vote on this one, but I promised them that I would pass on their concerns to someone who does have some control over that, and I would like to address that concern to you and communicate a growing concern among many of my constituents about the rising interest rates. Mr. Chairman, I have one other issue which I hope that Mr. Hove will address as in his comments or during the time he has to respond to questions, and that's regarding the nomination of the head of the FDIC. I don't want to imply that you haven't done an incredible job, Mr. Hove, under very difficult circumstances, but I am concerned that we have not confirmed a permanent head of the FDIC. We have gone through a savings and loan crisis in this nation, and the taxpayers are still footing the bill because some people were irresponsible. I'm pleased that Washington State was not part of the contribution to that. We have one of the best records and one of the healthiest savings banks industries in the country, but that concern remains out there. And I want to speak up right now as a member of this committee for the record. I'm very concerned about a number of the issues facing the FDIC in the future, especially the upcoming disparity between the BIF and SAFE funds. I'm very concerned indeed that a woman's wife has been on hold as she's waited for confirmation. She's a woman with an impressive record, and we need her in this office. Mr. Chairman, I have heard that the concern regarding her holding up her nomination is that she is a friend of Bill and Hillary Clinton. Well, I asked her about this, and she said she'd met them maybe 10 times in her life, never in a room with less than 200 people in it. So if that's considered a friend of Bill and Hillary and reason to hold up nominations, I think we have a serious concern in front of the United States Senate. I would like Mr. Hove, and frankly all of the panel, to address the question that I am posing here, and I hope that it's addressed directly. Is this country being well served by the Senate's confirmation process? Is the FDIC and by proxy all-American depositors being well served by this body failing to confirm for 2 years a permanent head of the FDIC, and what is the risk of continuing on this course? I will be listening for your responses, and I appreciate the time, Mr. Chairman.
Thank you very much, Senator Murray. Senator Mack.
Thank you, Mr. Chairman, and I find myself in the same situation as a number of other members of this committee with other things going on this morning, and I also have a 10:30 meeting that I need to attend, but I wanted to come by and frankly express publicly to you, because I have not done this before during our hearings, that I have now served on this committee for those 6 years. And I just want to say to you how much I appreciate the way you have conducted the hearings over the 6 years, the thoroughness in which you pursued issues, regardless of where the outcome may be, and the fairness in which you took your position. And again, one of the areas that I have had particular interest in has been trying to reduce the regulatory burden on the nation's banking system, and I appreciate the cooperative manner that we pursued those issues this year, and indicate to you that we are clearly going to miss you. And I wish you all the best of luck in your future endeavors, and we will miss you here.
Thank you. I'll miss you too.
Well, we'll let that go.
No, I mean that quite genuinely. We've had an excellent bipartisan relationship here, and I think those of us who've served over a period of years, and I'm finishing 28 years, and of course that covers House service as well. And you, of course, served earlier in the House and I think those of us who've had the occasion to do that, I, of course, have served in both parties, so that makes it maybe a little easier for me to think in a bipartisan way. But
I would say, Mr. Chairman, while I didn't serve in both parties, I have been a member of both parties.
Yes, yes, and but I think it's important that while we belong to parties, that there are some greater requirements here, and figuring out a way to work cooperatively on a bipartisan basis is essential to making the American system work. And I'm very proud of the fact that in this committee, over the 6 years that I've been chairman, to my recollection, I think we've only had one vote that was cast on a partisan line basis. I think on every other occasion, we've worked cooperatively, and we've produced bipartisan majorities, and we've worked our way through a number of very difficult issues. And I think we have achieved together a legislative record of which we can be justly proud. And so I will miss the senator from Florida, both as a colleague on this committee and also as a friend. Senator Shelby.
Chairman, I would be remiss if I didn't tell you I've enjoyed being with you on this committee for 8 years now, 6 that you've been the chairman. The first 2 years, Senator Proxmire was the chairman. And you have, I think, overall been fair to both sides of the aisle, and we have achieved a number of things. One thing that I won't miss, though, after you leave, is all the early morning hearings. You know, if we could just have them just a little bit later, you know. But you have worked, you've worked hard, you've had a lot of definitive hearings before this committee with some of the same people that are here today that say a lot, that do a lot, and it means a lot to our economy and to our banking system. So I wish you well in whatever you do. Lastly, before I get into some other remarks, I do hope this is our last banking committee hearing this year, and I hope that we'll soon be out of here as a session and can adjourn sine die. But having said that, Mr. Chairman, I want to welcome the distinguished group of panelists appearing before the committee today. They're no stranger to the Senate Banking Committee. I'm pleased that we will have the opportunity here today to hear your views on several pressing issues affecting the banking and thrift industries. Chairman Greenspan, it's always a pleasure to have you to testify before this committee. I believe by adverse possession you might belong here, you know, in some way. It's my hope that you will be able to address some of the broader concerns that I and others have about the ongoing role and the independence, which is very, very important, of the Federal Reserve. Mr. Chairman, I'm a staunch believer that the Federal Reserve must maintain its important and politically independent role of formulating and implementing U.S. monetary policy if we're to achieve long-term growth and economic stability. Long-term growth and economic stability. Very important. And I look forward to hearing from all of you here today. Thank you.
Thank you, Senator Shelby. Senator Faircloth.
Thank you, Mr. Chairman, and I want to, without making you feel like a pancake by pouring more syrup on you. I want to say that in the short 2 years that I have been here, it's been a total pleasure to work with you. You have done an amazingly gracious and firm job of directing the committee, and I think particularly your handling of the hearings were held on the Whitewater affair was a exemplary example of fairness and how to conduct a hearing, and I just want to tell you I was proud to be part of it and to have known you, and certainly wish you well in whatever endeavor you get into.
Thank you very much.
Dr. Greenspan, I especially welcome you and always do. I want to thank you for the job you're doing in containing inflation. As you well know, see that as one of the greatest dangers the physical integrity of this nation faces, and I think you're doing a great job of keeping your finger and arm in the dike, and I, as a citizen, appreciate it. The job you've done for America and are doing. Mr. Chairman, under your leadership, and certainly our senior minority member, Senator D'Amato, it has been a good year for the banking industry and the financial services industry, and we've moved forward, and we need to continue to move forward and make two things happen. We need to continue to streamline the paperwork and regulatory burden faced by banks and thrifts. The fundamental reality is that we live in a world economy. Capital is the lifeblood of that world economy, and market forces direct it. World capital markets simply will not cut slack for an industry that's overburdened with paperwork, even if it is created by the government. Today, money can move from banks to brokerage to insurance companies or around the world with the few strokes on a computer keyboard. If we make our capital markets more inefficient than our international competitors, then capital will simply go elsewhere. Socially desirable goals will not be met, and our society will simply be poor by the result of. So we need to continue to move forward with comprehensive financial service reform that recognizes reality. But a number of the senators have mentioned derivatives, and I think it's a financial tool that's understood very little in the general public, not a lot better in a large segment of the business community, and certainly by the Congress. And I would fear that we start writing rules and regulations that would restrict the freedom to operate for financial institutions with derivatives and whatever, because simply we don't understand them. I hope that we will be careful in what we do and move forward, but not start writing rules and regulations, something we don't understand. Second, I feel entirely different from Senator Murray. I think the first rounds of Whitewater hearing, if it taught us anything, it was that we need total independence in the bank regulatory systems and independent from anybody that might affect their decision. Certainly the FDIC is currently investigating the Rose Law Firm, Madison Guaranty Savings and Loan, and I don't see any way that President Clinton's nominee to head the FDIC, Ricky Tigert, who testified in front of this committee of her long and personal friendship with the Clintons for 8 years, and was quoted in Time and other magazines by Ms. Clinton as one of her favorite hanging out friends. I simply think at this time, with the cloud that is over the administration, that they need to withdraw the nomination of Ricky Tigert and come forth with a new person. I think we need somebody heading the FDIC that still thinks FOB means freight on board and not friend of Bill. Based on the hearings we just held, it seems clear that there was direct involvement of the White House legal counsel and others in advising Roger Altman and Ricky Tiger on how to react and to request to recuse themselves. This makes her reluctance to recuse herself and the convoluted logistics and the nature of a recusal in it more troubling. We do not need an FDIC chairman who has to recuse herself from conflicts of interest before she even starts the job. We need someone who is independent and who can and will go after any wrongdoing wherever they find it. I feel that I don't know that I've ever heard of anybody having to go to the ethics board, as she mentioned she would, to see whether she needed to recuse herself. Most people in government, if they need to check with the board to see whether they have an ethics problem or not, they have an ethics problem. We do not need another Roger Altman. Ricky Tigert is the wrong person for the wrong job, and it's the wrong time for her to be there. I hope the president will withdraw her nomination and a new nominee with no personal ties to the Clintons or to the Rose Law Firm will be submitted. Mr. Chairman.
Senator Bennett.
Thank you, Mr. Chairman. I cannot top my friend from North Carolina with the colorful phrase. To compare you to a pancake is probably the most memorable thing that will be said in this entire hearing. And
well, don't hold back on the syrup.
I didn't intend to. As the member of the minority party with the least seniority on this committee, I can say that you have treated me with the kind of respect that I think you probably grant to the most senior member of your own party. There has been no difference in your even-handedness and your friendship and your willingness to counsel and guide somebody who needs a little bit of help starting out. And I'm personally very grateful to you.
Thank you.
This has been a good committee to be on, and everyone has said that, and I shan't repeat the details that everybody has already put in the record, but I do want to add my personal statement about how valuable an experience it has been. Now, I bring you the experience of my predecessor and grade school classmate and your predecessor in the chair, Jay Garn, who assures me, and through me I assure you, there is life after the U.S. Senate, that Senator Garn is enjoying his life, and he says one of the things he enjoys the most out of no longer being a senator is the time he gets to spend with his wife and family. And I know you're working on an even younger family than he has, and so I give you that to look forward to, and I'm sure that was one of the major reasons for your decision to not seek re-election, that you would have an opportunity. And Jake says it's all worth it. He says one of the things I enjoy the most about no longer being a senator is the amount of time I can spend with Kathleen. As one who is your senior in total age, if not in the Senate, I can tell you that starting a new career at this age is a fun thing to do. Like my colleagues, I wish you well, and again, my personal thanks to you.
Thank you very much. I may seek your guidance as I start this new chapter, and I must say, and I know Senator Murray understands this too, particularly because she also has a young family, not quite as young children age as mine, but the nature of Senate life is that if you have two children at home, our youngest are 9.5 and 2.5, it's very rare that we are able to have dinner together during the week, or even that I'm able to see the children before they go to bed at night. Now, one might say, well, don't run for the Senate if you have small children, but I'd like to think we could sort of work things out in a way where maybe this life could accommodate families a little bit better. That's not an easy situation with our rules being what they are, but thank you for your personal comments. I've really enjoyed having you on the committee, and I think you're a tremendous addition to the Senate generally, if I may say so. And
You may. Thank you. I do want to mildly disagree, maybe not mildly. I want to disagree with my friend from North Carolina. I voted for Ricky Taggart the first time through, and I'm prepared to vote for her again. I think we cannot take the position that just because someone knows the President and the First Lady, they're automatically disqualified. And I've heard from enough of my Republican friends as to Ms. Taggart's qualifications that I'm satisfied that she would be even-handed in that position, and I'm prepared to vote for her again. But, we can disagree and remain friends on that issue, and I'm looking forward to hearing the testimony here.
I strongly support her nomination as well, and I understand there are differences of opinion on it. And Senator Mosley Braun.
Thank you very much, Mr. Chairman. I had to go and make a quorum in the Judiciary Committee, so I'm delighted to be back. And I see our witnesses have not yet testified, so I'm delighted not to have missed any of their observations this morning. Mr. Chairman, the subject of today's hearing, the condition of the banking and thrift industries, is an important one, and one I congratulate you, therefore, for having this hearing. As you've done during my entire tenure here, you've allowed us an opportunity to learn, to share information, to communicate with the people who make things happen in financial services industries. And I think that is a tremendous public service, and one that I hope that will continue after your tenure is over, that the next chairman will be as open and as activist a chairman as you have been. It certainly has been a help to me as a freshman member of this committee. Obviously, the banking and thrift industries play a vital role in our economy. They are a real part of the lives of so many Americans who use them as the repository of their savings, who use the credit cards they issue for so many purposes, who are able to own their own homes because of the home mortgages they originate, who buy cars using the auto loans they make, who obtain loans for the businesses from these institutions that create jobs, and who use these financial institutions' issues and the business loans they make to provide a variety of other needed financial services. We have a distinguished group of witnesses before us this morning to discuss the state of the banking and thrift industry, how their roles are changing, and what the future holds for these depository institutions and for our economy generally. And I look forward to the hearing and their testimony. At the outset, I want also to thank you, Mr. Chairman, for the help that you provided in ensuring that the Financial Services Commission legislation that I had authored was included in the final version of the Interstate Banking Bill that is now on its way to the President's desk for signature. I think the study this provision calls for a comprehensive review of our nation's financial system from the perspective of our economy and the users of that system, the consumers, farmers, businesses, and others that so depend on it, is greatly needed because of the huge changes sweeping the banking and thrift industries, the financial services industry generally, and indeed our entire economy. There are new products, new competitors, and new ways of delivering financial services that were not even imagined when much of the federal regulatory system was originally put together. It is time, it seems to me, to take a hard look at how these existing federal policies are handling those revolutionary changes. We need to see whether changes need to be made, and if so, what kinds of changes are most likely to help ensure that the financial services industry will be able to meet the needs of all of our people in a safe and efficient manner without putting the federal taxpayer at risk, and in ways that will help stimulate and help our economy to continue to grow and help us to continue to be competitive internationally. As we consider the condition of the banking industry, however, Mr. Chairman, we need to consider the fact that this committee and the Senate generally has a responsibility to see that federal regulatory agencies have the kind of strong leadership necessary to meet their responsibilities. In the case of the Federal Deposit Insurance Corporation, that means that I think we need to get a chair quickly who has been named by the President and confirmed by the Senate into place. The FDIC has been left without an acting chairman for over 2 years now. That fact, it seems to me, is a travesty. We have a very well-qualified candidate that this committee acted on a long time ago, one who was recommended to the administration by the distinguished chairman of the Federal Reserve Board, who is before us this morning, and by Beryl Sprinkle, the chairman of the Council of Economic Advisors in the prior administration. That candidate, Ricky Tigert, has the experience, the expertise, and the ability to lead the FDIC. She deserves a chance to do so. She has the support of a clear majority of this committee. In fact, I am not aware of any reason that goes to her qualifications or her abilities that would suggest that she is not fit to serve as the head of the FDIC. And yet, Mr. Chairman, she is still not confirmed. Ricky Tigert has sacrificed a lot to go into public service and to contribute to the public as a whole. She has given up all of her banking work at her law firm, which has been the overwhelming bulk of her practice. She's gone on salary there, even though she's a partner at the firm, in order to prevent even the appearance or any hint of a suggestion that she would benefit from this appointment, benefit personally. Frankly, it seems to me that in human terms, on a very personal level, as in do to others as one would have done to themselves, the continuing hold on her nomination for reasons that have absolutely nothing to do with her or her unquestioned ability and unquestioned integrity is clearly unfair, Mr. Chairman, and unconscionable. Moreover, Mr. Chairman, it is an abdication of our own responsibilities. The FDIC should never have to go for over 2 years without an acting leader. And if we do not act on the Tigert nomination before this Congress adjourns for the year, it will likely be at least 6 more months before we act on her confirmation next year. That would be nothing short of disgraceful. The FDIC is at the heart of our system of bank regulation. It is the guardian of the life savings of millions and millions of Americans. It is the guardian of the taxpayers' interest in seeing that we never have a repetition of the kind of insurance fund debacle that we saw in the 19th. It needs a head who has been confirmed by the Senate to head the organization. We need, I think, to act on the nomination of Ricky Tigert to be the new chair of the FDIC now and before we adjourn. It is our responsibility, it is our obligation and our duty to do so. And I would encourage, Mr. Chairman, that we do everything possible to see to it that with Senator Bennett's clout in the Senate, when we adjourn on the 5th of October, certainly that before we adjourn for the holiday season, that this nomination is completed and that we have finished Senate action on it. The FDIC, the issues are too important, and frankly, in my opinion, the opposition to her nomination is too specious to allow it to continue much longer. I understand that the Senate and the members of it have certain prerogatives when it comes to nominations, but there is also an abuse of those prerogatives that can happen. And I dare say, Mr. Chairman, in my opinion, that abuse is what we have witnessed in this case. I would like very much if the members who have withheld their support of this nomination would reconsider and would consider for a moment how they would feel if they were in those very shoes, and the old kind of basic human decency and the basic moral imperative in a situation like this, that they would withdraw such opposition and that we would be allowed to do the people's business and proceed with this confirmation.
Thank you, Senator Mosley Braun. Chairman Greenspan, you're our senior official there, and we're going to start with you this morning. We'll make your full statement a part of the record. We're delighted to have you back with us again. You and I were reminiscing before we started that I think maybe the first time we met in any official way was the day you took me into Gerald Ford's office when he was president. We sat, the three of us, together there to talk about inflation, among other things, and just economic growth in the country. So I have many fond memories as I call on you for your comments now.
Well, thank you very much, Mr. Chairman. My recollection of that period is that being 20 years ago, I had more hair, but you haven't changed. Certainly pleased to be here to discuss the condition of the U.S. banking system, especially at a time when the industry's performance appears to be so robust. But first, Mr. Chairman, I do want to take this opportunity to personally thank you for the working relationship that we have enjoyed over the years. You have probed the basis of economic policy with impressive insight. And while at times we have disagreed as President Ford used to say, never to the point of being disagreeable. You will be leaving the U.S. Senate shortly with an impressive list of legislative accomplishments. Under your leadership during a period of unusual turmoil and challenge, the Banking Committee has focused importantly on the safety and soundness of the American depository institutions and on the protection of the federal deposit insurance funds. It has also begun the process of modernizing the banking system. As you know, Mr. Chairman, the improvement in the condition of the U.S. banking system since 1991 has been truly amazing. From the end of 1991, the banking industry has written off almost $50 billion of bad credits, rebuilt and maintained its loan loss reserves, issued net $6 billion of equity and $12 billion of debt capital, supplemented such security issuance with $50 billion of retained earnings, and increased its total risk-based capital ratio to 13.2% and its equity ratio to 7.8% of assets, the highest in almost 30 years. The industry has also maintained profits both relative to assets and absolutely at record levels. At the same time, the volume of problem assets has declined by almost $50 billion to 1.1% of assets. And the number of problem banks has declined from over 1,000 to less than 350. With the volume of assets at problem banks declining from over $500 billion to $42 billion. Moreover, both here and abroad, U.S. banks have continued to be considered the most innovative in the world. While the industry's performance is highly encouraging, experience has shown that future problems, even when they are impending, are sometimes overlooked, and that banks need adequate general reserves for such occasions. At present, we see no major problems looming, but we should recognize that the risks are always there. The industry's average reserve balance, equal to 2.4% of outstanding loans and leases, however, remains high by historical standards, and when combined with the improved asset quality and capital ratios, seems adequate for the industry as a whole. In recent months, I have begun to receive reports, as others have, from examiners and from surveys that banks are competing more aggressively for loans and that they are relaxing their standards. Lending margins in particular, and especially for medium and large corporate customers, have declined, and loan covenants and collateral requirements have eased. These developments have benefits to the economy and in part reflect the easing of standards that had been sharply raised at banks as banks rebuilt their capital positions. It's too early to know if banks are easing excessively, but our examiners are sensitive to such concerns. I would note, however, that not only would our economy suffer if the banking system were unwilling to take risk, but its basic function and purpose would then be open to question. In becoming more willing to lend, our banks are fulfilling a traditional function. But in an environment of rapid technological change and global competition, U.S. banks, especially the larger ones, have also sought out new markets and techniques for serving the financial needs of their customers, including both trading and underwriting securities. Some observers have voiced concern about the risks associated with banks dealing in increasingly complex instruments. While these financial products are still evolving, we have insisted on and have been impressed by the sophisticated risk management and control techniques and policies that banks have used to manage their risk positions. It is truly impressive that during the first and second quarters of this year, when interest rates were rising sharply, the risk management systems of the large trading banks rapidly came into play to adjust and balance positions. As a result, most banks' trading operations have remained profitable so far this year, although below the unsustainably high pace of 1993. Indeed, of the 50 largest banks, only 3 lost money on their trading activities in the first half of 1994, and those losses were quite small. Moreover, the losses of these 3 banking organizations came from their mortgage securities rather than from the exotic derivative instruments that have received so much publicity. I make these points neither to belittle the degree of risk that banks are taking, nor to suggest that no mistakes have or will be made, but rather to underline the success of banks in implementing and the supervisors in insisting on very sensitive and effective risk management systems. In short, Mr. Chairman, based on our experience to date, these risks appear to be manageable, although banks must be vigilant in establishing and in maintaining sound internal controls and risk management systems. Some have suggested that bank trading and off-balance sheet activities have been the vehicles by which banks have maintained competitive position. Indeed, research conducted within the Federal Reserve System, as well as by the American Bankers Association, has suggested that when properly measured, banking's share of financial intermediation has not declined by as much as suggested by conventional indicators. Moreover, by some measures, banks appear to have more than held their own. This new research attempts to incorporate not only traditional statistics, such as bank loans, but also the estimated so-called credit equivalent amounts of the many new off-balance sheet activities, estimates of certain offshore banking operations, and other adjustments to the data that attempt to account for the effects of technological change and globalization. These results are interesting and provocative and give quantitative meaning to something we all know, that banks are adapting to and participating in the changes sweeping the financial services industry, as well as being severely challenged by them. In the last analysis, however, whether banks are expanding, holding their own, or losing market share is largely irrelevant, unless the changing share is being driven by outdated legal barriers or subsidies. It has always seemed to me that there should only be 2 tests for evaluating potential permissible activities at banking organizations. First, will the activity facilitate the efficient deployment of assets, capital, and human resources to meet the public's need for financial services? And secondly, is the risk acceptable on safety and soundness grounds? Our experience with Section 20 affiliates and trading activities of banks suggests that securities and trading activities meet these tests. This experience also clearly demonstrates that supervision by the Securities and Exchange Commission of Section 20 affiliates and the banking agencies of both Section 20 affiliates and bank trading activities has more than met the challenges during periods of market stress. Moreover, it seems obvious that the public is well served by additional competitors offering underwriting services. That is why the Federal Reserve supports a general reform of Glass-Steagall institutions. The benefits of so doing would be particularly strengthened as banks use their expertise for regional and smaller customers. Finally, Mr. Chairman, let me once again compliment you for your contribution to public policy. You will be greatly missed. Thank you very much.
Thank you very much. I'm touched and Thank you for those gracious personal comments. Controller Ludwig, let's go to you next, please. Put your full statement in the record, and we'd like your comments now.
Thank you, Mr. Chairman. Members of the committee, I want to thank you for this opportunity to discuss the current condition of the banking industry and developments that may affect the performance of that industry in the future. My written testimony discusses the condition of the industry in detail. In the interest of time, I'll submit it for the record and summarize the major points here. I want to limit my comments to three major points. One, the national banking system is healthy. However, we remain watchful for areas of possible concern. Three areas in which we are currently focusing our attention are underwriting standards, interest rate risk, and derivatives. Two, the continued vitality of the system, the industry's long-term safety and soundness, rests upon enhancing its long-term competitiveness. To achieve that end, we are engaged in a wide-ranging initiative to modernize our regulatory structure and to make our regulation more efficient and effective. Further, we are open to banks offering new products and services to their customers. Three, we are committed to assuring that all Americans have access to credit. Before I begin my comments this morning, Mr. Chairman, I first would like to commend you, sir, for your leadership of the Senate Banking Committee during a time of great stress for the banking industry. Mr. Chairman, early into your congressional career, you wrote of yourself in your book, "Oh Congress." You said, quote, "The only way I'm going to succeed is on the basis of brains and hard work." Under your leadership, the Banking Committee passed more legislation and more significant legislation than it passed at any point since the Great Depression. In response to the most serious financial crisis this nation experienced in the last 60 years, you assembled one of the most talented and dedicated committee staffs in this Congress. And you and your staff worked tirelessly to reconfigure the banking landscape. Specifically, your leadership secured the passage of 3 bills that restored faith in the deposit insurance system, stopping and reversing the decline of the bank insurance fund, and that improved the way of the Office of the Comptroller and other regulators supervise these institutions. The 3 acts were the Financial Institutions Reform, Recovery and Enforcement Act of 1989, the Federal Deposit Insurance Corporation Improvement Act of 1991, and the Regal Community Development and Regulatory Improvement Act of 1994. Further, the Regal-Neal Interstate Banking and Branching Efficiency Act of 1994 will stand among your lasting legacies. Mr. Chairman, your efforts have been instrumental to the progress made towards eliminating bias in lending and promoting greater access to banking services. Let me take particular notice of your abiding concern for and many legislative accomplishments on behalf of consumers of financial services and Americans in distressed communities. Because of your leadership, low-income communities and minority borrowers today have greater access to credit than they did when you assumed your chairmanship. Bank customers receive better disclosures of the terms and conditions of their investments and loans, and the range of competitively priced financial products and services available to retail customers is greater now than ever. Your chairmanship has been meaningful not only to America's financial institutions, but also to its ordinary citizens. That is a legacy in which you should take enormous pride. Mr. Chairman, It took talent and it took effort, but by any measure you succeeded. For more than a quarter of a century, Mr. Chairman, the nation has benefited enormously from your dedication and service. We will certainly miss your leadership.
Well, thank you. You're very gracious, and I appreciate your comments.
Let me now turn to the topic you asked me to address in your invitation letter, the condition of the banking system. Today, as a result of wise policy from the Congress and the regulators and hard work by bankers and examiners, I'm happy to report that the national banking system is sound. The industry has reported record earnings, capital ratios are at their highest point in 30 years, and the credit quality of banks' loan portfolios has improved dramatically. In addition, the increases in loan and asset growth that began last year continue. Reflecting this improvement in the condition and performance of the banking system, bank failures are at their lowest level since the early 80s. National banks have been recording record profits, as I mentioned, since 1992. In that year, they reported earnings of $17.4 billion, nearly twice that for 1991, and almost 30% higher than the previous record set in 1988. Last year, earnings climbed almost 50% to $25.7 billion. They continued strong in the first half of this year, reaching $13.2 billion, up from $12.3 billion in the first half of 1993. One of the more important contributors to these strong earnings is that banks have substantially recovered from their credit quality problems of the late 1980s and the early 1990s, due, among other factors, to the improvement in the economy. Over the last 3 years, the percentage of total loans that are non-current has fallen to 1.6%, its lowest level in 10 years. National banks have used their strong earnings to build capital, partly in response to FDIC's stringent capital-based supervisory system. Since the end of 1991, total equity capital at national banks has increased by almost 1/3. The aggregate equity to assets ratio has risen from 6.4% to 7.7%. And the aggregate risk-based capital ratio has risen from 10% to 12.5%. Moreover, the number of banks with any kind of capital deficiency has also fallen dramatically. At the end of 1991, 4.5% of national banks with 10.8% of national bank assets were undercapitalized. But by the end of the second quarter of 1994, only 0.3% of national banks with only 0.02% of national bank assets were undercapitalized. In addition to strengthening their capital positions, many banks have also changed the composition of their portfolios. Throughout 1992 and 1993, Mr. Chairman, you and a number of other members of this committee expressed concerns about changes occurring in banks' portfolios. Bank assets were not growing at a rate that was commensurate with the general economic growth or the level of financial activity, and bank lending was falling. In the last 18 months, the trends in asset and loan growth have been more than encouraging. As the economy expanded over this period, national bank assets grew at an average annual rate of 3.4%. After adjusting for accounting changes, compared to an average annual growth rate, compare that 3.4% to an average annual growth rate of just 0.5% over the previous 3 years. Loans outstanding at national banks increased more than holdings of securities over the last 18 months. Even more encouraging is that all three major types of loans, commercial and industrial, real estate, and consumer loans, increased over the last 18 months. 1993 was the first year since 1989 that this has occurred. In the first half of this year, all three loan types continued to grow strongly. The improvement in national bank performance has significantly reduced the number and size of national bank failures, as one might expect. In the year to date, only 3 national banks have failed. They held total assets of less than $200 million. In the years 1984 to 1993, we averaged 57 failures annually, and aggregate assets at failed national banks averaged $16 billion a year. Similarly, the number of problem banks continues to decline. As of last week, there were only 70 national banks, down from a high of 373 on the problem list. Mr. Chairman, I know how fortunate I am to be comptroller at a time when the wind is at my back. At the same time, Mr. Chairman, although the financial condition of the banks is brighter than it was just a few years ago, we are aware that we must remain ever vigilant for signs of trouble on the horizon and take actions to address issues before they surprise us. While we are pleased to see the numbers I have discussed this morning, we must remember that the business cycle descends as well as ascends, and that problems will again arise. Like the king of Israel who wrote in Ecclesiastes, we are ever mindful that the beginning of wisdom is the knowledge that things change. It is our job to worry about the problems that can arise and to watch for them. Again, at present we are focusing our attention on 3 areas: underwriting standards, interest rate risk, and derivatives. First, underwriting standards. As banks faced up to the credit quality problems of the late 1980s and early 1990s, they tightened their credit underwriting standards and reduced their lending. With improving economic conditions, banks re-examined their lending standards and rates and took steps to increase their lending. I've been pleased to see this. The purpose behind the administration's initiatives to encourage bank lending was to help banks respond to the needs of credit-worthy customers in economically rational ways without having to fear unwarranted, harsh responses by bank supervisors or unnecessary regulatory burdens. None of us, however, can afford to forget the problems of the past. In the wake of the disastrous results of commercial real estate lending of the 1980s, the Office of the Comptroller will insist that banks maintain prudent lending standards. To ensure this, we continue to monitor underwriting standards and loan pricing regularly. Recently, we conducted a survey of underwriting standards in which examiners met with large syndicating banks. We reviewed credit data and analyzed loan pricing information. The examiners found signs that some banks have eased their underwriting standards over the course of the last several quarters. Specifically, the difference between the interest rate charged on loans and the cost of funding those loans has fallen. And in certain instances, financial covenants do appear to be less restrictive. Some of these changes may reflect improved economic conditions and increased bank liquidity, but we are keeping a watchful eye on loan pricing and underwriting practices. Should we determine at any point that these practices are giving rise to any serious safety and soundness problems, we will take appropriate supervisory actions. Second, interest rate risk. Here we are focusing our attention on bank holdings of real estate loans and securities, chiefly mortgage-related securities. Since 1990, residential real estate assets in national banks have risen from 18.9% of national bank assets to 23.5%. Because these assets often have fairly long maturities, this growing concentration raises concerns about a possible increase in interest rate risk exposure at banks. As rates rise, banks can find themselves squeezed between flat earnings from fixed-rate assets, such as mortgage loans, and increased funding costs by having to pay higher rates on deposits. As you are aware, in the first half of 1994, interest rates rose significantly. Short and long-term rates rose over 100 basis points. This rise follows a period in which banks increased their holdings of residential mortgage loans and mortgage-backed securities. The squeeze on earnings could be compounded by a reduction in fee-related income, an important source of earnings at national banks. In 1994, non-interest income accounted for 35% of operating revenues at national banks. We routinely look at interest rate risk as part of our regular safety and soundness examinations. And at our largest banks, where we have resident on-site supervisory staff, we closely monitor interest rate risk. It is also important for me to stress that we expect banks to measure, monitor, and control their interest rate risk and to have appropriate capital, and that we will continue to work with the Federal Reserve and the FDIC on a specific interest rate risk capital requirement. Third, derivatives. The recent growth in derivatives markets has created new challenges for bank supervision because of the complex nature of these financial instruments. The Office of the Comptroller is working hard to ensure that banks using these instruments clearly understand and properly manage the associated risks that banks have with regard to market volatilities when they use these instruments. As you know, Mr. Chairman, we began strengthening our supervision of bank derivatives activities virtually from the day I took office. Just as, almost as immediately, we began strengthening consumer protection in bank sales of mutual funds and examining the operational and legal risks that banks take on when they engage in these activities. As encouraging as the recent improvements in the banking industry are, competition from other service providers and advances in technology and communications pose challenges to national banks and, by extension, to the way we regulate and supervise them. In response to changes in the marketplace, we want to make certain that national banks have flexibility to adapt these changes. Banks have changed, Mr. Chairman, but their evolution has been stymied by legal, regulatory, and supervisory restrictions. I believe that because commercial banks have been unduly restrained from entering new lines of business, they tend to gravitate to a few niches that promise the best returns. As competition has intensified over the years, the return for many traditional banking products and services has narrowed. For instance, credit cards were once the sole domain of banks, but in recent years, non-banks have become strong competitors, offering competitive rates and terms. In addition, banks face more intense examinations, higher regulatory costs, and broader obligations to their communities than do their non-bank competitors. The future of national banks will depend on our ability to accommodate their need for change to meet the needs of the financial marketplace, while at the same time providing cost-effective supervision and regulation to ensure safe and sound banking. We must allow banks to evolve so that they are more diversified, can earn adequate returns, and thus can continue to attract new investment. If they remain in increasingly low-margin businesses, they will either gradually shrink relative to other providers or take on higher risks within the scope of their permissible activities. I support banks' efforts to enter new lines of business and to provide new products and services to meet the needs of their customers. During my tenure, the Office of the Comptroller will continue to facilitate responsible national bank participation in the evolving financial services market. Our goal is to find the level of regulation for the industry that makes sense, enough to assure the safety and soundness of the system, but not so much that we stifle banks' abilities to compete. Lastly, Mr. Chairman, I want to say a few words about our special responsibilities toward ensuring fair access to services and enforcing the fair lending laws. At my confirmation hearing before this committee, I made this pledge. As Comptroller, I will work to remove discrimination from our financial system, root and branch. Since I took office, we have taken a number of important steps to improve the Office of the Comptroller's performance in the area of fair lending enforcement. Those steps are discussed in detail in my written testimony. And as you know, we are also striving with our sister agencies to revise how we carry out our responsibilities under the Community Reinvestment Act. Next week, we will issue a proposal that we believe will result in making the CRA the instrument of effective reinvestment that Congress had originally intended. This effort must be especially gratifying to you, sir, especially given your keen interest in the CRA for these many years. Over the past 2 years, we have seen significant improvement in the banking industry. Improvements in credit quality, higher capital, and steady growth have helped to restore the banking industry to health. We are heartened by those improvements, but we have not reduced our resolve to continue to provide the level and quality of supervision that is necessary to ensure the safety and soundness of the banking system. To ensure the long-term stability of the system, we must respond to changing needs of our banks and consumers, and at the same time expand our knowledge and improve our supervisory techniques so that we can fulfill our obligations to the public and to the Congress. Thank you, Mr. Chairman, and members of the committee. I look forward to your questions.
Thank you very much. Mr. Hove, we'd like to hear from you now. We'll make your full statement a part of the record and like you to proceed.
Thank you very much, Mr. Chairman and members of the committee. I appreciate the opportunity to testify this morning on the condition of the depository institutions industry and the deposit insurance funds. Mr. Chairman, on behalf of the Federal Deposit Insurance Corporation, I would like to thank you as your Senate career nears its end for your outstanding leadership of the Banking Committee during the recent years of turmoil. You've contributed significantly to the efforts to restore the health of the bank and thrift industries. The committee as a whole is also deserving of commendation for its support and guidance in turning around the industries and the insurance funds. It has been almost 2 years since I last testified on the condition of the banking industry and the bank insurance fund. A lot has changed during those 2 years. If insured bank failures have decreased from the 122 failures of 1992 to only 12 failures thus far in 1994. The FDIC's problem bank list has declined from 856 at the end of 1992 to 360 on June 30, 1994. The bank insurance fund has improved from a slightly negative balance at year-end 1992 to a positive balance of $17.5 billion at mid-year 1994. And we expect our third quarter financial statement to reflect that the fund will exceed the all-time high of $18.3 billion, which was in 1987. The banking industry's recovery from the troubles of the late 1980s and very early 1990s has been most impressive. The industry's 1993 net income of $43.1 billion was an all-time high. The average return on assets for the year was 1.20%. Marking the first time since the creation of the FDIC that the full-year return on assets exceeded 1%. More than 95% of all commercial banks reported positive earnings for 1993, the highest proportion since 1980. In the fourth quarter of the year, equity capital for the industry rose to more than 8% of total assets, the highest level in 30 years. Annualized return on asset for 6 months was 1.17%, with over 96% of commercial banks being profitable. The improved earnings results of the recent past can be traced to lower loan loss provisioning, reflective of improved asset quality, increased net interest income, and higher non-interest income. Troubled assets are at the lowest levels we've seen in 12 years that the banks have reported this category of assets. Underlying the improvement in the banking industry's performance has been a generally growing economy. For the medium-term future, however, any perceived linkage between the banking industry and the economy should be a cause for caution. The banking industry and its regulators should not let the euphoria of the current good times cloud the lessons of the past. The improved economic environment has also been a factor in the recovery of the trillion-dollar thrift industry. In 1993, the 2,262 private sector FDIC-insured savings institutions earned $6.9 billion, for an average return on assets of 0.70%. This is the highest reported in 10 years. Almost 95% of savings institutions reported positive earnings for 1993. The largest factor contributing to the increase in earnings came from lower provisions for loan losses. The core capital or leverage ratio for savings institutions reached 7.48% at the end of 1993, the highest level since savings associations began reporting this ratio in 1990. Only 8 savings institutions failed in all of 1993, compared to 81 failures for 1992. For the first half of 1994, the thrift industry's annualized return on assets was 0.63%. The condition of the deposit insurance funds reflects in large measure the condition of their respective industries. The bank insurance fund has increased significantly from a slightly negative position at the year-end 1992 to just over $13 billion as of December 31, 1993. 3 factors have contributed to the BIF's strong financial performance during 1993. Most important, assessment revenues of $5.8 billion substantially exceeded insurance losses and expenses. Only 41 banks with estimated losses of $0.6 billion failed in 1993. Second, the FDIC was able to reduce substantially the amount of reserves previously set aside for the estimated cost of future bank failures, adding approximately $7 billion to the FDIC's operating results in 1993. Finally, reforms enacted in FIREA and FDICIA, as well as the passage of the National Depositor Preference Statute, have helped to reduce the FDIC's resolution costs. Improvement in the financial condition of the Bank Insurance Fund continued into 1994. For 6 months, ending June 30, 1994, net income increased the fund balance to $17.5 billion, or 0.93% of insured deposits. If progress continues at the recent pace, the Bank Insurance Fund should reach its mandated level of 1.25% of insurance deposits by late 1995 or early 1996, with a fund balance of about $24 billion. At that point, the FDIC would review the bank insurance assessment rate to determine what level of assessment would be appropriate to maintain the fund at roughly the recapitalized level. Although it did not perform as well as the Bank Insurance Fund in 1993, the Savings Association Insurance Fund experienced steady improvement. The Savings Insurance Fund had a net income during the year of $877 million, raising that fund balance to $1.16 billion. Net income through June 30th, 1994 increased the savings insurance balance to $1.66 billion, or about 0.24% of insured deposits. As you know, the Savings Association Insurance Fund has 3 major obligations to, number 1, to fund insurance losses associated with failures of SAFE members that occur after RTC no longer has this responsibility. Number 2, to recapitalize the insurance fund to an amount equal to 1.25% of insured deposits. And number 3, to provide approximately $779 million per year of financing corporation bond interest payments through the year 2019. This FICO obligation currently represents approximately 47% of the Savings Association Insurance Fund assessments and adds 11 basis points to the SAFE premium. The Savings Association Insurance Fund is clearly not recapitalizing as rapidly as the Bank Insurance Fund. Even with negligible insurance losses, it will be many years before the Savings Insurance Fund reaches the congressionally mandated level of 1.25% of insured deposits. In addition to the diversion of assessment revenues caused by the FICO payment, other factors may adversely affect the SAFE's growth. Should one or more large thrifts fail during the next few years, the SAFE's, or Savings Insurance Fund, financial condition could be affected significantly. Beginning sometime in 1996, with the expected recapitalization of the Bank Insurance Fund and the consequent reduction in the BIF assessment rates, there most likely will be a significant disparity in the Bank Insurance Fund rates and the SAFE insurance assessment rates, which could create substantial pressures for insured institutions to minimize the deposits against which the Savings Insurance Fund premiums are levied. The resulting erosion of the savings insurance assessment base could ultimately affect the industry's ability to make its mandated FICO contribution. There are several alternatives for handling the Savings Association Insurance Fund. The FDIC has not taken a position on any of these alternatives. One alternative is simply to wait and see, to let the difference exist until SAFE is fully funded. Another alternative is to merge the deposit insurance funds. A variation of this alternative is to require BIF members to help pay for the FICO obligation. Other alternatives cover a variety of ways to accelerate the funding of the SAFE, including the use of any leftover RTC funds when the RTC goes out of existence, or government assumption of the responsibility for meeting the FICO payments. Finally, in view of the elements of fiducia and other laws that reduce the potential cost of bank failures, some have suggested it might be time to revisit the appropriateness of the 1.25% insured deposit ratio benchmark. It should be noted, however, that reducing the 1.25% target reserve ratio for SAFE would not eliminate the premium differential caused by the FICO obligation. Finally, a number of other issues currently facing the FDIC and the industry, which I mentioned in more detail in my written statement, include derivatives, consumer issues, and downsizing of agency personnel. In sum, the banking industry and the Bank Insurance Fund have largely rebounded from the difficulties of the late 1980s and early 1990s. The surviving portion of the thrift industry also appears to be reasonably healthy. Under your leadership, Mr. Chairman, the committee has undertaken a number of important reforms that have and will continue to benefit the banking industry, the regulators, the depositors, and the taxpayers. These industries and we, the regulators, now must be on guard against a return to the attitudes and practices that led to the recent nightmare. A major challenge for the FDIC is to provide adequate safeguards while also accommodating a dynamic and innovative financial system. The FDIC, as insurer, relies to a great extent on the efforts of other regulators. Effective channels of communication among regulators will be crucial as the industry consolidates and risks become more complex. Also, as the primary federal regulator of state non-member banks, we must work with the industry to meet the banking needs of their communities. By meeting these challenges, the FDIC can help banks continue to fuel economic growth while maintaining a safe and sound banking system. Thank you very much. I look forward to responding to your questions.
Mr. Fichter, your written testimony will be made part of the record in its totality, if you'll just briefly sum up. My colleagues have gone to vote, as you know.
Thank you. Good morning. Appreciate the opportunity to appear this morning. I want to take this opportunity to echo the sentiments of the others on this panel and the committee members and congratulate you on your distinguished career as chairman of this committee. As you know, August 9th marked the 5-year anniversary of the enactment of FIREA, the most significant piece of legislation affecting the thrift industry since the creation of the Federal Deposit Insurance System in 1933. The FIREA legislation was taken up first by this committee under your leadership, Mr. Chairman. It is therefore especially appropriate to take stock of the successes we have achieved under that law. I would also like to discuss the most critical issues that now confront the thrift industry, that is, the condition of its insurance fund and the cost of its deposit insurance. The Savings Association Insurance Fund is less than 1/4 of the way toward meeting its statutorily required reserve level of 1.25% of deposits. As a result, savings institutions may in the future pay insurance premiums at a rate that is over 3 times higher than their commercial bank competitors. Before turning to the challenges that we must face in the future, however, I would like to briefly review our accomplishments under FIREA. In 1989, The thrift industry and the federal government faced what some have called this country's worst financial crisis since the Great Depression. The thrift industry operated at a net loss of $13.3 billion and held less than 2% tangible equity capital. The FIREA legislation was enacted in the summer of 1989. A theme of FIREA was that thrifts should return to their more traditional role of providing housing and consumer finance. One important provision in FIREA was the setting of specific minimum capital requirements for thrifts. Today, in part as a result of the insistence on adequate capital that was written into the statute, the thrift industry that OTS regulates is healthy and well capitalized. For 1993, thrifts reported net income of $4.9 billion and a leverage capital ratio of 7%. Troubled assets have declined from a post-FIREA high of $39 billion, or 4% of industry assets, to $14 billion, or less than 2% of assets in the second quarter, a trend that is evident across all regions of the country. Another important provision of FIREA was the establishment of a separate process for resolutions under which OTS transfers non-viable thrifts to the Resolution Trust Corporation for disposition. From the time this process was established through the end of 1993, the OTS transferred 744 institutions to the RTC. Thanks to the success that the staffs of the two agencies have achieved in their efforts to coordinate the transfers of non-viable institutions, the process worked quite smoothly. Today, I am pleased to say that the cleanup is virtually complete. For example, in 1989, 100 institutions with assets totaling $135 billion to the RTC. By contrast, so far this year, OTS has transferred only one institution with $107 million in assets. These figures provide concrete evidence that the thrift industry has returned to financial health and illustrate that FIREA was in large measure a success. Despite the health of the industry, however, I am concerned with the level of reserves held by the SAFE. SAFE is less than 1/4 of the way towards achieving its statutorily required reserve ratio of 1.25. Moreover, within the next 2 years, as Chairman Hove pointed out, SAFE-insured institutions may have to pay a significantly higher premium for deposit insurance than BIF-insured institutions. When the SAFE was created, it had no funds. It also inherited the prior obligation of the FSLIC to pay interest on certain debt, the FICO bonds, that had been issued beginning in 1987 to cover FSLIC shortfalls. The annual interest payments for the FICO obligation, $779 million, take priority over the SAFE's obligation to cover its own operating costs and the need to build insurance reserves. When FIREA was enacted in the summer of 1989, it appeared feasible for the SAFE insurance premiums both to service the FICO debt and capitalize the Thrift Insurance Fund. A critical assumption was that the thrift industry would grow at a rate of 6 to 7% per year. As a consequence, it was also assumed that the FICO burden on the SAFE would fall over time. The deposit growth assumptions, however, that supported the transfer of the FICO obligation to SAFE have not held up. Instead of a 6% or 7% positive annual growth rate, total deposits of SAFE member institutions have declined on average by about 6% a year. The result is that the FICO payments represent a much greater burden on the SAFE than had been expected when FIREA was passed. Both the SAFE and the BIF are required to reach a reserve ratio of 1.25. Once that occurs, the FDIC is authorized to reduce deposit insurance premiums for fund members. While the BIF is rapidly approaching the 1.25% level, the SAFE is not. A major reason recapitalization of SAFE is slow is that a substantial share of SAFE's income, 44% in 1993, has been diverted to the FICO interest payments. But if a healthy thrift is forced to pay 23 basis points for insurance, while a healthy bank pays only 5 basis points, the thrift will face an uphill battle to retain its franchise. The shrinkage we are now seeing in the safe assessment base appears to be due primarily to the high cost of deposit insurance. The principle at work here is very simple. When the cost of a product increases, demand for the product will decrease as users seek out alternative products. This erosion of the safe assessment base may only grow worse when the safe BIF premium differential takes effect. Let me emphasize that there is no current crisis, but while the number of safe insured institutions projected to fail over the near term is quite low, I cannot assure you that the industry will remain healthy forever. If we allow the safe to remain underfunded and the safe assessment base to continue to erode, we are taking a risk. Ironically, the higher the safe premium is, the more failed institutions it may be called upon to handle. In recent years, a number of large troubled thrifts have been successfully recapitalized by infusions of funds from the private sector with no government assistance. Going forward, however, private sector investors may be very reluctant to put money into a financial institution that has insurance costs that could be 3 to 4 times higher than their competitors' costs. These circumstances suggest that other funding mechanisms must be found, either to capitalize the safe or to cover the FICO obligation. As I noted at the outset of this statement, the overall financial condition of the thrift industry has improved dramatically over the last 5 years. Despite this recovery, however, thrift profitability remains materially lower than that of its competitors. For instance, in 1993, the return on assets of savings associations has been about half that of commercial banks. My concern is that there are a number of forces at work that are not based on the market. One unintended consequence of these non-market forces may be that the thrift industry will slowly shrink in importance, not because it is failing to serve its customers, but because of a unique set of regulatory costs that make doing business as a thrift too expensive. Another unintended consequence may be that thrifts are perversely encouraged to take on more risk in an effort to remain competitive. I list in my testimony a number of regulatory costs that the thrift industry currently bears. The challenges facing savings associations are difficult. At the federal level, we should do all that we can to ensure that the value in the industry, its capital, its earnings, the housing it fosters, the credit it provides, and the jobs it creates, is not lost through our failure to understand the consequence of a patchwork of policies. Savings associations have come a very long way since the enactment of FIREA 5 years ago. The industry that has survived deserves credit for the substantial gains it has made, but there is much that remains to be done. In particular, the capitalization of the safe and the impending disparity in insurance premium rates should be addressed promptly. I am hopeful that the issues I have discussed with you today will form a part of the committee's agenda in the next Congress. Thank you.
I'm going to recess the committee. We've still got a chance to get this vote till the chairman returns, and then he'll pick up Mr. DeMoores. Just be patient for a few minutes. I'm sure you'll be here.
Committee will come to order. Let me indicate that vote's still on. Other members I know will be coming back here shortly. As I understand it, Mr. Fichter, you were in the middle of your statement.
Oh, I actually finished.
I see.
Thank you.
Very good. Let me just say I want to welcome Norm DeMoores, a former House colleague and a good friend, and we're delighted to have you, and we'll make your full statement a part of the record, and we'd like your comments at this time.
Thank you, Mr. Chairman. I'll make a relatively brief statement. Chairman Regal and members of this committee, it is a particular pleasure and honor to appear before this panel as you conclude a long and distinguished congressional career, Mr. Chairman. I want to thank you for your service to our nation, for personal kindnesses, and for your admirable leadership of this committee, which has been clearly evidenced today by sincere bipartisan accolades you have received in this room. Mr. Chairman, federally insured credit unions continue to be strong and in good health, and the Share Insurance Fund enjoys a capital to insured shares ratio that stands at 1.27%. During the first 6 months of 1994, federally insured credit unions have performed most admirably. Delinquency declined by 10% to 0.9% of total loans. Credit union capital grew 5.8% to $28.5 billion, and the capital to asset ratio reached 9.8% on June 30th of this year, the highest level ever and the 9th consecutive year in which credit union capital increased. Soon after I became chairman, only last November, we confronted a number of problems associated with the structure and the investments of corporate credit unions, a subject I know you have a particular interest in. A study commissioned by NCUA corroborated many of the findings of the 1991 GAO study mandated by Congress, and I would like to submit that study for the record with your permission.
Without objection, make it a part of the record, and pleased to have it.
Thank you, Mr. Chairman. The NCUA Board intends to issue regulations in the near future that will address many of the capital, investment, and other problems cited in our corporate study and in the GAO report that have not already been addressed. For instance, almost half of today's 44 corporate credit unions are closely tied to their state credit union leagues, either through interlocking boards, management arrangements, or in some cases both. This structure creates a real potential for conflicts of interest, and such conflicts have occurred. The NCUA Board only last week issued for public comment a proposed rule that will, if adopted, require that at least a majority of a corporate credit union's directors, including the chair, be individuals who represent member credit unions and who do not serve as officers, directors, or employees of credit union-related associations. Recently, the NCUA Board established a separate office of corporate credit unions that has the sole responsibility for examining corporate credit unions and supervising their programs. This office reports directly to the NCUA Board and will be working to significantly upgrade the professionalism, the competence, expertise, and effectiveness of our corporate examiners. Another area that greatly concerns me and the Board is the paucity of new charters being granted and the dramatic decline in the number of small credit unions. By working with the credit union community, we will encourage the proliferation of new and small credit unions. The creation of a new Office of Community Development Credit Unions, which I will refer to again below, will facilitate this development. Included in the Regal Community Development and Regulatory Improvement Act of 1994, just passed and scheduled to be signed tomorrow, is a $10 million authorization for the Community Development Revolving Loan Program for credit unions. The National Credit Union Administration was given the responsibility to run this revolving loan program in 1989. I simply want to assure you that the demand for loans is great, and we are confident that we can make prudent use of the additional funds your bill provides. Also, as one of my first actions as chairman of NCUA, I established within our agency, with the cooperation of the Board, a separate Office of Community Development Credit Unions reporting directly to the chairman in order to focus attention on low-income credit unions and to facilitate their chartering. Mr. Chairman, I'd like to briefly discuss credit union investment. Because loan growth lagged share growth for so many years, credit unions put their excess liquidity into investments. Investments now constitute 40% of the assets of federally insured credit unions, and this comes at a time when there is a much greater risk in some of the modern investment products available. Now, credit union investments have always been very conservative, both by statute and by regulation. For instance, NCUA's rules and regulations strictly limit investments in derivatives. Investment in CMOs and REMICs are permitted only if they pass a strict average life and sensitivity test. Residuals such as strip mortgage-backed securities are prohibited unless they are made solely to reduce interest rate risk. Federal credit unions may not buy or sell futures contracts. We carefully monitor compliance by credit unions with these strictures, and we continually remind credit unions that the best investment they can make is a loan to a member. Mr. Chairman, during your tenure in both houses of Congress, you have played an important role in making several changes that have significantly and beneficially affected the credit union system. More recently, or fairly recently, you authored a series of credit union amendments that passed the Senate as part of the Federal Deposit Insurance Corporation Improvement Act of 1991, FDICIA, but didn't survive the conference. However, I want you to know that those amendments and GAO's FIREA-ordered 1991 credit union report became an important reference point that resulted in several important regulatory changes that have been made and some that are being contemplated by the NCUA. Finally, Mr. Chairman, I'm pleased to report that through agency realignment, we have reduced NCUA's annual expenditures by some $3 million. Given our agency's size, that is significant. And we have also increased the number of women and minority staff members in supervisory positions. And this will be an ongoing effort. So with that brief statement, I thank you, Mr. Chairman, for this opportunity to report on what has been going on at NCUA and the progress we have been making. And if you have any questions, I should be pleased to respond.
Thank you very much. I just take a quick personal prerogative, if I may. I thank you all for your statements. I have some questions I want to get into. Tonight, the Senate is having a dinner in which they are honoring the retiring senators in both parties, and which there are several in addition to myself. So it creates the good fortune where our families are here with us in town today. And I have the good fortune to have my wife, Lori Hanson Riegel, over here, who some of you had a chance to see, and I'm delighted that she's able to be here in the city today and in the hearing room. I was saying to Alan Greenspan, because Lori and Alan Greenspan have worked together before on Social Security issues when the Commission did its work several years ago to put a much stronger financial foundation under Social Security, that Lori has just been named to a 6-year term on the advisory board that will oversee the newly independent Social Security agency, and as a professional in that area for the last 20 years, well, I am not seeking another 6-year term. She is about to embark on one, so I'm very proud of that fact, and she'll make a great contribution to the country in that area, I'm sure. Let me go right to a question that I think is a front and center question, and that's the issue of charter shopping by financial institutions that may not particularly like, for one reason or another, the regulatory regime they find themselves in. Banks, as we have seen, are becoming much more aggressive about switching charters, mostly from national bank to state bank, but also S&Ls shifting out to, in fact, become banks. And then oftentimes that's to avoid regulators that they don't like for, as I say, one reason or another. And I'd like to just go right down the table in the order that we had you testify and ask you, Chairman Greenspan, then Mr. Ludwig, Mr. Hove, and Mr. Fichter, how concerned are you about this charter flipping, and what is to prevent federally insured depository institutions from switching perhaps to what they might perceive as the weakest regulator?
Well, Mr. Chairman, let me just start by saying that we at the Federal Reserve do not solicit charter switching. Indeed, in earlier years, we lost membership as some of our members shifted out of state member bank status to national or non-member status, and there's been a flow going back and forth. I think that the important issue which we discussed in the context of the issue of consolidation, as you recall, a year or so ago, the basic problem is that so long as the statutes are sufficiently clear as to what the regulatory structure should be, I am not personally concerned that within the narrow areas of differences of various different regulatory regimes, that there is an economic problem here. I do think that as we and the Comptroller and the Treasury Department have observed that there are cost differences which are partly to blame on occasion. And I think that we ought to look at that sort of issue in some detail. But if you're asking me at the moment whether I think there is a significant threat to the system, I would say not at this stage.
So what would be your response?
Well, I think that this is a serious issue, and solicitation of institutions for a charter choice, I think, is a affirmatively pernicious matter. It sets up a dynamic in the regulatory structure that is not desirable. Indeed, it was Federal Reserve Chairman Burns some years ago that warned against competition and laxity. And I think we've seen a great deal of solicitation, I think almost unprecedented, going on in this area, and letters, videotapes, meetings, and I think that's inherently pernicious and creates underlying weakness in the system.
Mr. Hove?
Well, let me also say, as Chairman Greenspan did, that the FDIC has not been soliciting and will not solicit institutions to switch a charter either from a commercial banking charter or a federally chartered thrift. That we are very sensitive to the issues that both Mr. Ludwig and Mr. Fichter will point out, that we understand the issues of the regulator maintaining the ability to have their fees fund their organization. It also is important to have states that have innovative issues in their banking system and have banks have a choice in that in selecting their charter. The issue of insurance funds, clearly the same insurance premium is paid by national banks and federally chartered thrift as by state banks and state chartered thrifts. We provide the examination for the state non-member banks, and we also provide the examination for the state chartered thrifts. There is an argument that you could present that there is some inequity in that, but I would say that all banks pay an examination fee to their chartering authority. Whether that fee is the same or not really is an issue of the states and of the OCC and of the OTS. Is it an issue? Yes, it's a very serious issue, and I'm very interested in looking at this along with Mr. Ludwig, Mr. Fichter, and Chairman Greenspan.
I think it it is a serious issue. Obviously, one of the benefits in this country is that we have a very dynamic market, and I recognize that as the market changes, both technology, demographics, that there will be market-driven reasons why institutions may choose to change the nature of their business, and in some cases that may require a change in charter. I think to the extent that there are non-market-driven reasons for changing, I think you, Mr. Chairman, addressed one of the issues that we had at least found was causing a lot of institutions to shift from our supervision to that of a state, which had to do with the mutual to stock conversions. We at the FDIC board have worked closely to try to eliminate differences in the rules that extend to an institution. They go from mutual to stock regardless of who they are chartered under. And as a consequence of that, in part, we have seen a fairly sharp drop in the number of institutions that are converting. I, in my testimony, list a number of different, and in some cases, somewhat unique costs that thrifts face that I do not believe are either necessary from a regulatory standpoint or from the standpoint of market-driven. And I hope that the committee next year can take some of these up.
I'm going to give you some follow-up questions for the record on this, but one thing I am concerned about here, given the fact that it's a somewhat fluid situation, and that is there are some published reports recently that indicate that some financial institutions may have changed or attempted to change their charters in order to avoid enforcement or investigative efforts. And I don't think we would want that occurring, and I would like to have an understanding with all of you that in those kinds of situations, if somebody's, in a sense, sort of on the run from one regulator because of some matter that's arisen that's of some concern and consequence, that that we will not have an encouragement of that, and other regulators willing to sort of take people in under those circumstances. I think that would be an aspect of this that we would not want to see. And can I have a response from you on that?
If I may, Mr. Chairman, I think we all agree with that. I think that none of us would encourage the acceptance of charters to our various authorities, which were fleeing, as one puts it, some legal mandate or some investigative problem. I think that we're acutely aware of that and would eschew that, I think, very forcefully.
I assume the others agree with this? Yes.
Yes, Mr. Chairman. I think this is a critical item, that it's that very sort of competition and laxity that Chairman Burns had pointed to. It's very, very damaging to the system, very damaging to the enforcement of federal laws.
I think it's also important, and I want to make it clear that I think to the extent that were being done either to escape fair lending requirements, which is a problem in our society, and if any of us we suddenly found ourselves as part of a minority community for a day or a week, I think we'd understand it in terms of the real reality of the situation. But I would not want to see that being done either for purposes of community reinvestment requirements or fair lending requirements. I mean, I don't want, it isn't just a question of somebody trying to move out because, they've had some other kind of improper action going on. Perhaps it's under investigation, but I don't think we can have a situation either where the system isn't operating fairly and with the same general application of effort to ensure that it's fair. I mean, that's why we're here. I mean, there is a public interest requirement, as I know you all know and feel, that this system be available and be working in a way where there's some real equity in it in terms of access to credit and to the system, and that we not have some of the continuations of some of the patterns of denial that we've seen in the past that have nothing to do with creditworthiness. So I just think that's part of the way we hold faith in the country is to make sure that people who are out there understand that the system is on their side, not just on the side of the other fellow, but on their side as well. So in that area, I would urge you to hold to a high standard and not have a situation where, you know, we sort of get a sort of a race to the bottom in terms of enforcement of basic laws that have to do with fairness. Can I have such an understanding? I think everybody's either nodding in the affirmative or speaking in the affirmative. So let's let the clerk so record. Chairman Greenspan, I don't want to digress to any great degree from what we're here about today, but I do want to pose a question that I think is an important public interest question that I raised to you before we started the hearing, and that is the concern that everyone has in the country as to how the economy itself is going in terms of not just growth, but inflation pressures and interest rate pressures and so forth. And I mentioned to you at the outset that we've all been observing sort of the upward pressure on long interest rates in the last period of time. And I would welcome and ask your comment as to how we're doing just with respect to the overall functioning of the American economy, how you see that fitting into the global economy with respect to either pressure on interest rates coming out of the market, separate and apart from what actions that the Fed may or may not have taken or need to take in the future, and just your current assessment. I'd like to have that, and I think it's important that we give you a chance to offer it here now.
Mr. Chairman, I can't add terribly much to what I stated during my last testimony under the Humphrey-Hawkins Act. The economy is doing well. There's no question about it. It's solid. It's a fairly solid underlying growth. I think it is clear that the rate of growth is slowing from the earlier fairly exuberant growth that occurred late last year and earlier this year, but it's still unclear as the extent to which the rate of diminishment is proceeding. The rest of the world is clearly doing better. That is, there's been a significant improvement in the outlook for Europe. There is evidence that Japan is finally working its way through some of its difficult problems and showing signs of recovery. And in that respect, there is a fairly broad global expansion that's going on, and it's the healthiest economic growth we have seen in quite a substantial period of time.
Are we beginning to press up against any supply limitations on either raw materials, labor, capital that are starting to change the picture either globally or as it feeds back into the U.S. Economic picture?
Well, I can't really add to what I said at my last testimony. The data show, as I indicated then, that slack has diminished in both the product and the labor markets. But our view continues to be that we must look under the aggregative data to make certain that what we are seeing are evidences of pressures. I don't think that I can add terribly much to my extensive commentary the last time I was here.
Well, I might say that I think part of the story, an important part of the story of the recovery of bank balance sheets and the balance sheets of other institutions relates in large part, important part, to the low interest rate environment that we had for some period of time, due in part to the fact that the economy was weak and we had other problems and so forth. But I think it's fair to say that in the spreads that financial institutions that we're here to talk about today were able to work with and earn substantial earnings as a result of have really been a key part of the story of the strength we now see. So that period has been really quite essential, I think, not only to the recovery of asset values in certain cases, but also to rebuilding these balance sheets, and you've talked about that before, and I think it's a central fact. And I think the question that I'm hearing more and more people raise, not just citizens that Senator Murray talked about in the grocery store, and I'm hearing that too, but also from business leaders, and that's the question of whether we're going to be able to maintain a balance between growth and controlling inflation and not having interest rates ratchet up so high that all of a sudden we find ourselves, with that becoming a real drag on the economy. When I look across the United States, I see a stronger economy in many ways, although there are still pockets of problems, particularly the size of the underclass and a lot of people still sliding out of the middle class and sliding backward. A lot of people working part-time that want to work full-time, and there are major disadvantages to that. But I'm wondering, again, the degree to which the rising strength in the global economy at some point here will come back and have an increasing impact on what happens here in the United States. I mean, we are a global economy. When Ron Brown was here yesterday to talk about American competitiveness, it's all in the context of the fact that we now have a world system, and profoundly so in our capital markets and in our financial relationships. And so I think it's very important for us to understand the degree to which events beyond our shores may relate to the question of how much maneuvering room we have with respect to trying to fine-tune our own economy and what kind of pressures may be there. And my hope would be that maybe you never know if you're in a rough equilibrium situation or not, I suppose, until it's tested by events. But we are getting good growth. I think inflation does seem to be essentially moderate and, if not completely under control. And I hope we can stay in that pattern. I hope we don't get into a situation where we start to get a ricochet effect where the interest rate sensitive parts of the economy were to suddenly find themselves, hit hard. I know that's not the intention of the Fed. I don't just address this comment to you, Chairman Greenspan, but I'm hopeful that we can stay sort of where we are. You've emphasized before that the country is, if you look at its overall economic prospects, I don't know your exact words, but you've said here recently that you think it feels about as good in the aggregate as you've seen it in some years. And you're nodding in the affirmative, just for the record. And I think a lot of hard work by a lot of people in and out of the private sector and government have been bent to that end to try to bring that about. So hopefully we can continue to get a run here of strong economic performance, continued growth without the inflation and without sort of getting into these spikes in interest rates that we've had to deal with in the past. I know your intention is to avoid that, and you're trying mightily to do that, and we want to help you. I think our budget package of last year was designed in part to relieve some of that fiscal pressure. And I think, if memory serves me right, we will now have 3 years in a row where we've actually reduced the federal deficit over what was projected. And that's the first time that's happened in going back virtually decades. And so hopefully, as we subtract some of that fiscal stimulus, if you will, in terms of where the track that we've been on, that will ease some of this pressure, even if global capital requirements are rising. So we'll be watching it very carefully, and I know you at the Fed are as well. Let me come back to our other subject here. And I'd like to ask two other things here, and then I'm going to provide some questions for the record. On this difference in deposit insurance premiums is between banks and thrifts, a recent report by the Safe Industry Advisory Committee indicates, as was said here earlier, that the thrift industry is soon going to be paying considerably higher deposit insurance premiums than banks. And increasingly, there is discussion about a possible merger between the Bank Insurance Fund and the Savings Association Insurance Fund. And I'm wondering what each of you think might be the risks of any large, long-term premium disparity. Would that be a problem as you would see it, Chairman Greenspan?
I do, Mr. Chairman. I've raised this question at length in the last year or two, as indeed my colleagues on both sides of me have. And I think we're aware that if you get a competitive disparity of significant order of magnitude, you create a situation in which you have a movement out of the savings and loan industry, fewer resources within the SAFE fund. Since the FICO bonds are a fixed cost, as Mr. Fichter said, you run into the continuous pressure where you have a significant fixed cost, but the resources decline, which means that the average premiums must rise for savings and loans, which means they are less competitive, and you go through this particular cycle. And I think that it's quite important that this issue be resolved, and I think it is a difficult issue because you're really asking individuals who have succeeded in not imposing themselves on the American taxpayer to pick up the cost of people who have. And that is an extremely difficult issue to resolve, and I think it's one, however, which is going to be put on the table for all of us next year. As Chairman Hove indicated, the data suggests that the long-awaited and important, and I say very desirable adjustment in commercial bank insurance fees is approaching, and that's the point at which the solution has got to be addressed. I mean, this problem has got to be addressed.
Mr. Fichter, why don't you follow?
Well, I'd like to, I totally agree with the comments made by Chairman Greenspan. I would add, as I expressed in more detail in my testimony, the one additional concern, which was that to the extent that the thrifts become less competitive as they pay the higher insurance premiums vis-a-vis banks, that because the SAFE fund is so far from meeting its target of 1.25%, I have the additional concern that in the future, as thrifts become weak, it will become much more difficult for those institutions to recapitalize without government assistance. As a consequence, you have a weak insurance fund being even more burdened with additional thrift failures than might be the case if we could figure out over the very near term a way to at least put thrifts and banks, healthy thrifts and banks, on more of a level playing field in terms of their insurance costs.
Mr. Hove, what thoughts do you have?
Well, I would concur with what Chairman Greenspan and what Mr. Fichter have said. It is an issue, excuse me, that is coming very soon. As I mentioned in my testimony, we look forward to the day very soon when the bank insurance fund will be recapitalized. We are also faced with the issue that Chairman Greenspan pointed out, that a merger of the fund or a sharing of the FICO obligation by institutions that really had nothing to do with it is imposing a tremendous burden on those institutions. But the burden is there, and I guess you could make the same argument that the thrifts that remain clearly were not part of the problem either. They are the healthy thrifts that have remained, like the healthy banks. It's an issue that is going to take a lot of thought, a lot of deliberation. There are some alternatives. I guess that we've described one of these alternatives is the merger of the fund. There may be some other alternatives that I have described in my written testimony, but it's an issue that I think is going to be need to be addressed very soon next year.
Mr. Ludwig?
Well, to address this adequately, I think takes a considerable amount of study. You have to determine precisely when the funds will come in balance and what that imbalance really means in dollars and cents, how long the imbalance is going to take place given the relative healths of the industry. So I think there's a great deal of study as an FDIC board member, we have to do before one can determine what an ideal solution is. It does seem really quite unfair in a way that the institutions that had nothing to do with the problem, be they banks or some of these healthy thrifts, should be the very institutions that bear this load.
I want to just cover with you also the issue of interest rate risk, and I want to address this to you, Chairman Greenspan, and to Mr. Ludwig and Mr. Hove, and that is, if we were to see a sudden shift in interest rates, we hope not to see that, but if we were, it's conceivable that we could see some failures or near failures of financial institutions. In fact, the Congress addressed this issue 3 years ago by requiring capital requirements to actually reflect what we call interest rate risk. In the meantime, derivatives positions at the banks have more than doubled to some $15 trillion in what we call notional value. I know the OTS issued new rules last year regarding this. When will we see the other regulators doing that? Chairman Greenspan?
Well, I think hopefully we're pretty close. I mean, we've all been, the staffs of our agencies have been working closely together on this. It's a very difficult issue, largely because the technology is changing rapidly under us and enabling significant interest rate structure risks to start to emerge, which you have to address. In other words, ideally, what you want is a model which captures fully the exact effect of any interest rate changes on the capital of an institution. In order to do that for every institution, it's extremely complex, so that we all have to take a somewhat more truncated summary version of the process. One, to avoid the tremendous heavy regulatory burden that we could impose, and two, nonetheless, to have something which does capture the mismatch between the maturities of assets and liabilities, and hence the risk. As the markets continuously change, that mechanism, whichever we choose, is going to have to change. And I think what we are working on now is to try to find a mechanism which will work for a while, and hopefully we are getting fairly close. If our staffs don't quite get to final resolution, I think the group at this table will get together and we will get it solved.
Well, I think that's important, and I would strongly urge that. Sometimes staffs can resolve things, and sometimes they can't. I mean, that the principals have to sit down and finish closing the gaps, and I think it's important that that be done. Mr. Ludwig, you want to comment, and then I want to hear from Mr. Hove as well.
Yeah, I would make two observations. I think that we're past the statutory deadline here considerably. This is an area of genuine worry. This is a classic example of why the current regulatory system doesn't work. Multiple regulators bickering about an important rule is just unacceptable in areas of risk. If this were done by any of these agencies independently, they would be able to take this non-sort of politicized issue, there's no great politics in this, it's a matter of technical precision, and be able to do this in a reasonable period of time. I've instructed my staff to work with the agencies as aggressively as they possibly can to get this done, because this is terribly important. I mean, it's lamentable that this kind of structure impedes progress in an important area.
Well, again, our agency is working very closely with the other agencies to come to some closure on this. And as Chairman Greenspan mentioned, we are very close to coming to this. It is a very difficult issue because it does change and changes rapidly. But we look forward to the day very soon when we will have an interest rate component to the capital.
Let me, I want to sort of bring this whole discussion back around and ask you to reflect on your earlier testimony, your prepared testimony, and the summaries you gave, and that is I'd like to just go down the table and ask each of you what you think the greatest either immediate or long-term problem is that faces the industry that you're regulating. And what is there out on the horizon that, when all is said and done, is the source of greatest concern to you and that we really have to have on our radar screen here? Let me start with you, Chairman Greenspan.
Well, Mr. Chairman, I think that we're all aware that there's an extraordinary acceleration in technology and telecommunications, which has rendered the financial system far more dynamic, both for the United States and for the rest of the world, so that we have got a rapidly changing global system which reflects the state of knowledge and reflects the state of technological advance, which very significantly affects the type of products that the financial industry and the banking industry in particular sells. I think it's important for us to be acutely aware of the dynamics of these changes and to adjust our regulatory approach increasingly to observing the process by which risk management the way risk management evolves in the various institutions. And I would say at this particular point that it is very important for us to make certain that our supervisory and regulatory approach increasingly encompass the dynamics of the system. And so what I would say is the greatest risk, if one wants to put it that way, is also our greatest challenge, is to adjust to what is an extraordinarily rapidly changing system. I might say one of the reasons why we have been reluctant to sanction changes in legislation is that we're worried that under this dynamic system with this dynamic system with which we're dealing, that we do not inadvertently stick rigid barriers to change, which would occur if inappropriate legislative actions were taken. This does not mean that we should not be expanding our supervisory and regulatory reach, because indeed we are, and indeed we will have to do as the complexity of the various products and the various structures begin to become ever more manifest.
I might just indicate on that point to you and to others following this that I have planned a hearing which will take place next week on the 28th on looking at the dynamics of the U.S. and world capital markets. And we will have as witnesses that day Gerald Corrigan, Leo Melamed, Arthur Levitt, and also Felix Rohatyn to come and help sketch out the dynamics that they see from their respective vantage points to try to, in a sense, give us more understanding on what these changes are, both the technologically driven changes and the market structure changes and the globalization process. I think this question of where the world capital markets are going and how that will impact us, is impacting us, as a critical issue for the future, and I want to lay down as strong a foundation of insight as I can as I turn this chairmanship over to the next chairman. So we will be dealing with that next week, and if anybody has any supplementary information that they want to give us to put into that record that day, we'd welcome having that. Would you like to come, by the way?
Appreciate your invitation.
Mr. Ludwig?
We are in a period of dynamic change, and we face genuinely extraordinary challenges, even though the industry is healthy. This industry, as I indicated in my testimony, must evolve in order to stay competitive and, in the end, be safe and sound. At the same time, we must have a supervisory mechanism that is strong enough and complete enough to see that change occur in a safe and sound manner. And there are various parts to that safety and soundness net, you might say, that really have to be in place. The current regulatory structure is not, in my view, as strong as it should be. A consolidated regulator made sense. It makes sense. We run risks with the current structure, as you've indicated with respect to the charter conversion issue. We have to be on top of these issues. There are additionally, we have to make sure that we have the wherewithal, the technical personnel that are able to appreciate the changes and supervise. I'm confident at the Office of the Comptroller we now have those people that can supervise a changing industry, but it's something we have to continually be vigilant of. If we don't allow the industry to evolve on the one hand, we present ourselves with serious safety and soundness problems. On the other hand, we have a regulatory apparatus that needs change.
Mr. Hogue, what do you see that you want to flag for us today?
I would agree with the comments that both my colleagues have made in the area of the need for maintaining the technological skills in the regulatory agencies that we can, in fact, assess the risk. I would suggest that we also need, and the challenge we see is the ability for the industries to maintain their competitiveness both in this country and throughout the world. More focused just to the FDIC. The FDIC is an interesting organization because as we see the industry gaining health, this agency has to be flexible enough that we reduce the size of our agency. Our workload goes down as the industry gets bigger. So one of the challenges that we face at the FDIC is resizing this agency, the FDIC, to be in a much healthier environment, but at the same time to have the key people that if we run into another situation that we still have key people there that can handle a crisis if it should occur again.
Mr. Victor?
Well, I'd like to, I guess, pick up on a couple of the different comments made. I think the immediate issue for the industry is resolving the BIF safe issue. I think longer term, there are some real questions that have to be asked, I think, with respect to the role of the thrift industry in housing finance. As you know, the GSEs now pretty much dominate the conventional market. You'd mentioned earlier in your remarks, Mr. Chairman, about the importance of the Community Reinvestment Act. When that was passed, most mortgages were made by insured institutions that came under that act. Today, the majority of mortgages are made outside the insured depository institutions. The effect of this uncertainty on the thrift industry has a more immediate effect on the Office of Thrift Supervision. As we testified in February when we were discussing the issue of consolidation, at the end of this year, OTS will have half the staff that we had 4 years ago. I was in New Jersey yesterday at a regional staff conference where some of the key people that I think are important for the agency to retain to take on the kinds of risk that Chairman Greenspan mentioned asked why they should stay in an agency that was shrinking 10 to 15% a year and where there was not a clear light at the end of the tunnel. At some point in time, I'm afraid, if we don't either consolidate the agencies or give the head of the OTS a better ability to convince key people to stay on at the agency, we could run into the kinds of problems we had in the mid-'80s of an understaffed and undercapitalized, if you will, thrift regulator.
And I appreciate your putting it on the table as directly as you have.
Mr. Chairman, I'd like,
Yes, please.
if I could. Credit unions are unique, of course, in their history and in their structures. But I would like to take the opportunity to remind this committee and members of Congress in general that credit unions, too, are having to adjust to the new complexities that are caused by their own growth, by modern financial instruments, by new technologies. And our challenge, I think, is to deal with this while not losing the public support and the political support that without which the credit union system could not continue to survive, and we are doing that. Our mission, my mission as chairman of the agency and the mission of the board, is to see to it that the public understands and that Congress understands that we cannot remain hindered by horse and buggy technology in this given modern developments, but that we are nonprofit, member-owned, member-operated in a democratic manner, cooperatives whose function and whose operations are to provide financial services to the inner cities and to people who have not been served by more traditional financial service providers in this country. We are doing that. We are under there's some misunderstanding growing out there, and some of it driven by competitive needs, some of it driven by honest misapplication or misunderstanding of the history or statutory authority credit unions. But I just hope this committee, certainly this committee, and the Congress to understand that the purpose and the function of credit unions stand inviolate. Of course, there are problems dealing with growth, but we are in control of that, and I can assure you that the mission still obtains.
Thank you. Chairman Greenspan, let me just raise another issue with you. It's my understanding that the Federal Reserve has concluded an agreement with a California, it's actually concluded that an agreement by a California bank with a greenlining coalition to try to help ensure that the bank is meeting its fair lending objectives, that the agreement that they've worked out between them would somehow violate a Fed regulation. And as I understand it, the agreement calls for the bank to collect on a voluntary basis data on race, ethnicity, and gender only from business owners who actually had obtained loans from the bank and were no longer applicants. And the question that arises as we've looked at this and as I've asked the staff to examine it is, why would it be appropriate to prohibit collection of race and gender data when the efforts to collect it are voluntary and they're aimed at improving lending to what are traditionally underserved groups?
Well, Mr. Chairman, that goes back, has a long history to it and relates to the promulgation of Regulation B by the Federal Reserve, which covers the area that you're discussing. The evaluation of Reg B is currently under review by the Federal Reserve Board, and I think that we will come to a conclusion on this sooner rather than later. I can't go further into it because we're not quite sure precisely where we're coming out, but the initial Regulation B, which was promulgated, stipulated that you could not collect data on gender, race, or other non-economic factors. The reasoning behind that, which goes back a long way, is that it's always been the position of the Federal Reserve Board that lending in a private capitalist free market society should be involved only with the types of pieces of information which are economically relevant. And there was always a concern that collection of data on other than those characteristics would raise issues of discrimination. We are reviewing the broader questions, and hopefully we'll have that issue resolved within a reasonably short period of time.
Well, as you know, we've got a lot of data now, including some from the Fed itself, parts of the Fed, and we know from our own experience that there have been some grievous patterns of lending discrimination that have nothing to do with economic factors. And so, and I know you don't necessarily disagree with what I'm saying, but I want to make sure that by living with old doctrines that purport to only look at economic factors when obviously other things are at work that are distorting economic decisions and denying credit to creditworthy people, that we face and solve that problem. And there are some people that want to do it. I know you want to do it, so I'm not suggesting anything. But there are other people around in the bureaucracy that don't want to do it, quite frankly, in my view. And they have different reasons for doing it. I don't say they do it because they somehow have a sort of a discriminatory attitude or a racist attitude. They can be so fanatical about their view of the free market as such that when it works imperfectly and even illegally in terms of discrimination, they can't see it because they have a blind spot. I mean, I've seen people like that, and I've seen them in bureaucracies, and I've seen them in elected positions and what have you, and it's hurting faith in the country. And it's wrong. It's against the law, and it ought to be stopped flat out. And everybody, I think, has some obligation to be something of a leader, moral leader in that area. And so I would hope when this gets looked at, I don't just aim this at the Fed, I'm speaking to all of the regulatory agencies at once here. I think when an African-American citizen of this country or a Hispanic person in this country is trying to make their way in the face of what are other problems with discrimination in our society, as regrettable as they are, they're a reality. And they find that when they hit the credit system, that it is not absolutely fair and objective and unbiased, that it creates an impossible difficulty for many to have the kind of upward mobility that our whole economic system is designed to encourage. I mean, we want people in America to be able to have the American dream work for them and to have hard work and enterprise and effort be able to cause success and success that spreads out and helps other people. So I must tell you, after 28 years in this job as both a Republican and as a Democrat, and I think I'm as close to the people of my state as any one of the 100 senators. I've had over half of my staff in my state in 7 regional offices for the 18 years that I've been a senator, and I listen carefully to people. I talk to them. I was at a Labor Day parade in Detroit just this last Labor Day. I probably talked to 1,500 people at random, and I mean talk to them and listen to what they were saying. We have problems in terms of a perception and a reality of a lack of the kind of fairness that we need and access to credit within our financial system. We're trying to deal with it. We're trying to improve it with laws, with practice, with more understanding, with more sensitivity, and so forth. But the cold fact of the matter is, and the data is there to support this, including what I hear from people talking to me, that we have a distance to go here in making our institutions work in a way that are truly colorblind and that are not, you know, also having embedded in them some kind of a redlining process where somebody shows up to get a home loan or to get a business loan or something else and would have economic facts that would warrant that and in some fashion or another turned away either because they're black or because they're out of the wrong area and so forth. I believe as strongly as anything I've done or sort of dealt with over the period of time of my life in public service that solving that problem and making sure that this country works for everybody is just about the most important thing we have to do. I mean, we can't expect that people are going to have faith in the country if the country doesn't work on a fair and equitable basis. And if you can't get access to credit in the United States for artificial reasons of denial, it's pretty darn hard to function or to have much faith in the country. And it's just wrong. It's wrong economically, it's wrong morally. It doesn't have to be that way, and it can be fixed. But I can tell you as I sit here right now, I know there are people in this Congress and in every one of these regulatory agencies that do not have the sensitivity on this issue that they need to have. And they're not going to have it until they get it from each of the 5 of you. That's to be dealt with,